Okay, good morning and welcome to the Minervini Private Access Training Room. I'm Bob Weissman. If you could raise your hand, just letting me know that you're hearing me loud and clear. And I'm also going to take that as applause for my Eagles winning 11-1 now. Thank you. And let's also test Mark Ritchie out. Good morning, Mark.
Morning, Bob. Morning, everyone.
And if you can just raise your hand, letting us know you're hearing Mark Ritchie. Looking good there. And we'll get started now by handing it off to Mark Minervini. Good morning, Mark.
Good morning, Mark. Tell Bob no one cares about his Eagles.
Yeah, well, I mean, we're ripe for a disappointment. Let's put it that way.
Okay. Good morning, everyone. Hope everyone had a good weekend. So again, we're seeing the market come in here, and I just want to follow up real quick on my comments over the weekend during the study session, and how I was pointing out within the downtrend, when you got to these levels where in the VIX, we went between that 20 and that 33-ish level that were sort of acting as overbought, oversold levels. What you need to look for is when that flips. So when you start to get where you stay persistently, overbought, if you will, and then it flips around where on the pullbacks now, those oversold conditions start acting as support, and then you start getting into an uptrend. And we still haven't seen that just yet. I think we're at that point now. This is where we want to start looking for it. And then, of course, the stocks. And I just want to point out a few names here that are, something like an NUVL, in a really strong market. Something like this, I missed it. I'll buy it here on this pullback. It follows through for a day, reversal recovery, then it follows through. Now that first pullback, I'll step right in here and buy it as it starts turning up. In this market, yeah, you got to be real careful, of course. But what we have here is a number of names that some are breaking out, few are working, some are stalling out, and some still need time. Something like a TMUS. This is where, again, let me just pull this out, see what's actually happening here. Yep. So it's growing into my scenario here that I was envisioning. So if we can tighten up a bit more, this is what we want to see more of this tightness on the right side as the market pulls back. A proliferation of names like that, something like ASO here. This is one that a member brought to us during the during the Q&A session, and it's pulled back here. See, still needs to build that right side a bit. And then you've got some where you've got like an AMR where you see you're still building this big base here, but you're leaking off a bit. As you tightened up, now you're getting a little pivot, what I call pivot leakage, but that's certainly still within the confines of, tightening. And this could just be the final tightening before you set a viable pivot. So that's what I'm seeing across the board here. APA, trying to come out this morning, and now on a gap, of course. That's why I don't chase gaps. Again, really strong market. If this was a growth name in a strong market, I probably, as this pulls back and squats like this, trade now near the danger point, I'd probably just go in here if it starts turning up and maybe buy some there. And then if it can get into new high ground, follow up on my position. But in this market, it's a bit more challenging. So we got to be careful here. Something like MGNI ran up here again, a quick 20% move, certainly a nice trade. You take some off, and now you finance your risk. And if if we got this right real early here, it could be a much bigger, longer term move. Real quick, Mark, any change in your posture or the way you're approaching things here?
Not much. I added a little to ENPH Friday. Sort of like I think we talked Thursday. REGN's another one. That looks like it might be setting up a subsequent pivot. This is how I want to potentially, increase exposure. If this like you said, if this pullback's orderly and we get some of the names we either, are watching tighten up and improve, that's where, I'm going to get more aggressive.
Yeah, and I realize, there's a lot of eyes on ENPH, and because, of course, there is a small list of names that are setting up, it seems to get more attention on them because there's not as many. But again, if something like this can't work, then it's really going to be hard for many names to work. When you get a setup this perfect, spend a lot of time here reversing, tightening up quite nicely, volume in. I mean, everything just setting up just right here. You got fundamentals, strong group. These are really canaries in the coal mine. If we can't get traction in these type of setups, then once again, we're certainly on a orange, stem, if you will, at best. So again, just keep your powder dry here and take it easy and incrementally move into this market, but with knowing that there may be another shoe to drop here, and even if there isn't, if we move higher and end up mapping out the 1962 type scenario where we run up this right side, and that would correspond also with the seasonality and the presidential cycle, it doesn't mean that we're going to get the participation without volatility. So you may still have to wait, and who knows, this might be like the scenario where I showed 1994 into 95, where we don't start really getting aggressive until we're in new high ground. I don't know. But again, what I do know is the current stock setups right now are still not, we're not in an optimal set of circumstances right now. So let's see what you guys are thinking.
Yeah. First question is coming from Oscar, who is asking if he has, I'll just sort of paraphrase this long question, but $15,000 of exposure, and he finds one setup to have a risk of 8% and another one to have a risk of half that. Would you say it's better to put more money in the name that has a tighter stop and less in the one with the greater stop, or would you use equal size positions for both, regardless of the amount of risk of either name?
I'll let you answer that first, Mark.
I think either is fine, so long as as long as the stop's acceptable in terms of the range. Did you say 8 and 4, Bob?
Yeah.
I mean, normally, by the math, I usually am not going to, if I'm going to put on a position, let's say, for the things you said, 15,000 or something like that. Let's say I put on equal positions. I'm probably not going to take the entire position down to the 8% stop, say, versus the tighter one, where I'm looking to average things out about the same. And ideally, assuming liquidity is good, I want to get a bigger position on in the names where I think the stop is tighter, because presumably my timing is going to be better.
Yeah, I would agree with Mark. Again, I know we're always looking for a formulated quantitative way of approaching the position sizing and pyramiding, or progressive exposure, but a lot of it comes down to your own personal tolerances and so forth. And there's a lot of ways to do this, but within a framework, really within a framework. And the real key is, and as Mark is saying too, is, to incrementally move into, when the market's good, to being heavily invested. And whether that's, going to be, this particular time around when you first start getting invested and pyramiding on positions, whether it's going to be 25%, 20%, 15%, in the long run, it's not going to really, it's going to kind of come out in the wash. These things kind of come out in the wash, as long as you're, sticking to some good basic guidelines. Even the loss, you want to average, you should average 5 or 6%. If you're drawing the line in the sand at 8 and maybe 10 or 12 staggered, you're going to fluctuate around an average. And I could tell you that all this sort of figuring out the perfect way of doing it is not going to affect that average very much. And I'm not saying not to completely try to optimize and perfect your trading, but knowing that we can't trade perfectly. We can only perfectly trade our plan. And that's just something I just tweeted about that this morning, about how trying to avoid regret. And I don't know if I said it well enough this morning on the tweet, or maybe it needed more elaboration, but the real indecision and the problems that creep into your trading come from trying to avoid regret and worrying about making that perfect decision, or selling and it goes higher, holding too long, but we're not going to make those decisions perfectly. It's all about making more profits than you have losses, and doing it over and over. So just try to keep focused on the goal. I know I digressed there, but I just want to give you a little bit of color. Also, just real quick, I see there's a question about Sean Ryan, David Ryan's son, in the U.S. Investing Championship, which of course he's doing really well. In second place. I was hoping he's been trying and taking shots at it for, I don't know, 4 or 5 years in a row, and he keeps coming up just a little short. Second place, fourth place. So again, he's right there in second place. But I see the comparison here is and the question is, Sean Ryan's up 153%. Mark Ritchie is down this year 7%. Does this show in this difficult year for swing trading, does Sean Ryan's astounding performance move towards leaning to short-term trading instead of swing trading? And I can tell you that I haven't spoke to Sean recently, but I spoke to him not too long ago, and that's precisely what he's doing. He's very short-term trading. As a matter of fact, I had a discussion with him. He wasn't up nearly this much and was getting frustrated. And I had my discussion with him was to short-term trade even more, and to nail the profits and to start financing his risk. He wasn't financing the risk. He was doing a lot of short-term trading, but he wasn't sort of covering himself and financing the risk. So I told him, I made a suggestion. I said, try financing the risk. I haven't talked to him since, and I don't know if that's what's helping the performance, but since then he's doing really, really well. So, but he is very short-term trading. I know that.
All right. Question from Greg is asking for Mark Ritchie. You mentioned you bought PCVX. Can you tell us how you managed your risk on the day it broke out on the 28th? That it came out but closed poorly. Did you reduce at that point?
Let's take a look at that.
The power squad, as you call it, Mark.
Yes, I did, for that precise reason. Normally in a situation like this, I wouldn't, I think the percentage on this one was right around, maybe it was a 6-7% squat. This has been the theme, right? The poke and squat, the pop and drop, stock pokes its head out. This was acting really well. And I was just buying a small sort of pilot test position. And when it reversed the entire breakout, I just stepped aside for a tiny loss because it's exactly the opposite. A setup, you see how tight this was beforehand? If you sort of roll this back prior to the breakout day, this name should have just gone. And really blast. And it did blast off. And this is, once you take out the high like that and then squat, you're sort of reintroducing supply. For those of you who were at the Master Trader program, we talked about that concept, which is why the bigger the squat, sort of the more ominous. This is sort of borderline in terms of percentage, but given the theme, it was enough for me to just say, you know what, I'll step aside.
And the rubber is really, meeting the road here. This is where, if it doesn't, work out on that breakout, and then it has this sort of power squat, well, the couple days back, inching back towards the reversal, a great sign. And what we'd want to see is it recover that reversal and get a reversal recovery. But now, and it tightened up. That's great. Matter of fact, if it tightens up and gets through that reversal recovery, very often I'll either buy it back or I'll add to my position. But here, we're going in the opposite direction now. Now it's starting to leak off. So this is it. I mean, if you're still in it, this is where the rubber meets the road. And again, these are the canaries in the coal mine. When you see these type of situations, you tried to break out here. Okay, it was short. Then it shook out. Now it tightened up and now it's perfect. Bang, comes in again, can't rally. Now tightens up even more and now leaking off. This just tells you that, you're in a market that is tricky. It's not, because these kind of setups are just going to go take off and not turn back in a good market. We are in a bear market. I just want to remind everybody, we are still in a downtrend, right? We are below the trading basically with the 200-day in the market in a downtrend, and most of the indexes. The only really sign of real light that we have here is the Dow 30. Just keep that in mind. When you look at the market, you look at the indexes, the Nasdaq's trading pretty close to its bear market low. The S&P has been contained under the 200-day moving average for the entire move. And there's only 30 stocks that are price weighted that are performing well as far as the indexes are concerned. So just try to keep it into perspective.
Victor is asking if you could critique his buy on AEHR on December 1st.
So December 1st is over here
at 26.72.
Yeah, I mean, look, it's just you're buying it a good distance from any base. Here's your base here where you come out of this wide and sort of sloppy cheat area and you gap out. So that's what kept me away from it. With of course almost no uptrend whatsoever. Then you form this little pause pivot here. You sort of complete a base, and then from there you get a natural reaction. And now, I mean, probably the spots that I was looking to buy was here and then over here, and then after this pullback on the pullback buy turning up either on the 21st or the 22nd, And now, I mean, this is really sort of follow-up buy area. If you bought some, let's say you bought some at the cheat here and you add it here, maybe you add a little bit more here if you're pyramiding, on this early turn. So you get moderately aggressive here, very aggressive here, and then a little less aggressive here. That's sort of like a pyramid buy, where what I'll do sometimes is I'll start off on the low cheat and I'll take maybe a quarter position. Then it sets up and it improves. And now I add, double what I added my first position, or take it all the way to a full position. But let's just say I double it. Now I'm at 75%. Then it breaks out, pulls back, a successful pullback, and maybe I add 25%. So now I start to pare back and I'm not running up my average cost. So I'm sort of backing into telling you how I would normally play something like this. You're coming in here, a little late. So, but if you're going to do this, this is the way to do it. Come from a tight pivot after you've pulled back. You got a natural reaction. I think it's a fine buy, but it's certainly not buying it out of the base.
SHLS.
SHLS.
Right. Question from Michael is asking, the stock had a public offering on December 1st, which is what caused the stock to drop, with 20 million shares being added. Should we regard this like any other sell-off, which means the chart would be broken, or should we view it more like a stock split, as if the sell-off never happened?
I'll let you answer that, Mark.
The former. Yeah. Well, first of all, I don't ever want to regard anything like it never happened in terms of the price. Obviously, some of these adjustments, this is not an adjustment. This is supply being, put into the market with that offer.
That's not an adjustment for splits. It's a big difference. A split doesn't change anything. But go ahead, Mark.
I was done. I was saying, this chart is, it's negative, and I mean, there wasn't really much of a, it was a stock in an uptrend. This could still base out here and put in the right side, but there's just no pivot here right now. And I would say, that supply is sitting over the market.
So don't take this the wrong way, but I just want to, when I hear these questions, it's like a tripwire for me that I know, I've trained thousands of traders and talked to, tens of thousands of people as far as, about trading over the years. And when someone asks that type of question, I know that if this stock turns around and goes up and you sell it, you'll be one of those regret people that'll be going, see, I knew I shouldn't have sold it. I knew it was just that secondary. And and then you'll go and you'll make that mistake later, because you'll judge the result as being the reason. The result doesn't justify the means, but you'll judge it based on the result. So I would be really careful. It doesn't matter if this stock recovers, and let's just say, we're not saying that the stock can't go higher. We're just simply saying if it hits your stop, you've got to manage the risk, because otherwise you don't have a stop. If you're going to all of a sudden say, well, the stock's down, table, I'm going to wait till the end of the day. Well, then what happens if it just all of a sudden just opens up from there and just starts galloping down? Now you're down, instead of 8%, you're down 12. What are you going to do then? You're going to wait more? So really, let you say, oh no, well, I would sell then. Well, then your stop's 12%. It's not 8%. So again, these are those little things. If you add these things up, these little decisions that you say, well, just this one time, I'll break the rule, or it's because of this, and you start putting caveats and asterisks all around your trading. Sorry. You don't have a discipline anymore. You don't have a discipline anymore. And before you know it, your average loss, instead of being 5 or 6%, will be 9 or 10%, and your math goes out the window, and then you wonder why you're a losing trader. And it's all because of decisions like that. So just want to caution you to, be careful about making decisions like that.
Yep. Raymond's asking for EE. The buy price on last Friday is 29.13. Could you explain why we buy at that price? If it is the pullback buy with 4 days of pivot, shouldn't we be buying above the November 28th high?
The November 28th high? No, I don't know where you get the 28th high. Well, first of all, let me just put this into perspective here. Hold on. Just move my chart around here because this is covering. So EE, we bought on 12/2. let's just, whoops, sorry about that. Let's mark that. So 12.2 is right here. So I'm not sure. I mean, maybe you're looking at these two highs. Certainly you can use that as a pivot. You know, again, this is an art form. It's not a science. You know, a pullback buy is not a science whatsoever. I decided to buy it as it was moving above this high, which was on 12.1. And I was buying it what I would call on the move. All right. So I did use a pivot, if you will, and made sure that it's moving in my direction. But I was okay with that, trading very close to what I call the danger point, the low of the pullback here. Certainly, if you wanted a bit more confirmation that it was moving up, you could have waited till it took out these reversals. That's fine. There's nothing wrong with that. Or another way is, like I bought it, start buying it a little bit here, and then when it gets through here, you add to the position and you incrementally. And that's normally how I will do it. But I'm not taking very big size right now, so I'm not having to scale on a lot of trades. Some trades I am having to scale, but most of them I'm not, because I'm not trading the big size anymore. I might trade 5,000 shares and just in one click I've got that on, as opposed to 50,000 shares that I would be scaling in. So again, that's the reasoning. I'm just looking to buy the pullback, and as soon as it starts turning up, I want to buy it as close to this danger point as possible. But you are correct as far as, it did not get above these highs here, but you got to make, that's a choice that you have to make. I wouldn't say this was the absolute best pullback buy either, to be honest with you. This was a okay pullback buy, but a really great pullback buy would have been if it tightened up even more, and then from that tightness took out those highs that you were referring to.
Ravi's asking if you can explain what is going on in WWE. I can't tell if it's going through a natural reaction or trying to form another base. I'm not sure how to interpret the quick drop on November 3rd and the subsequent rise afterwards.
I don't know what what to interpret. I mean, it dropped, pulled back to the 50-day, and this will happen. I mean, you can interpret this very easily. I mean, look at how this just wedged straight up and never paused on the right side. So you never had a right side built out here in the base. So what happens, this is what I call relative symmetry. There's always a price to pay. So when you don't clear out that supply, now what happens is that you leave some supply on the table, for lack of a better term. And now you'll tend to get sharper pullbacks because it's sort of setting the record right. You know what I mean? You should have weeded through it here. Instead, you moved higher, and now you've got a bigger price to pay. So you'll weed through it a lot harder as you get that selling that you'll get from some profit taking, and also from that selling that maybe supply that should have been over here. That's sort of that's not the greatest way to explain it, but that's the way I look at it. As far as when we wedge up this right side with no development of the base, it doesn't give the stock the proper time to go through that changing of the hands. And what I find is that you'll get the sharper pullbacks. So this is actually pretty natural. And now, yeah, you might form a little, another little base here. You're looking at 1, 2, 3, 4, maybe 5 or 6 weeks here. So if you can tighten up here, this is one that you could probably entertain as a potential.
Okay. Michael's asking about PSN. Broke out of a massive primary base recently, showed a bunch of confirmations. It is now forming a short stroke base or a natural reaction and looks very constructive. Is this something you're looking to entertain?
So this is the big base here, yeah. And if you take a look, here's the weekly. So you got a really big base formed here, and it came out right here. I love the breakout on the weekly. You can see 1, 2, 3, 3 weeks up, and then you've gone a bunch of weeks tight. So that's acting really well. Of course, on the daily, you're a bit extended from that initial base. I mean, the buy point was clearly right here on the 21st. You had an outside day though, but it did tighten up. I would have liked to seen that tighten up a bit more. Again, now remember, I'm always talking about a theme. So if you were to look at this market right now, what would you say the theme was? Well, one theme would be where we have a lot of squats. You break out, we know that that's been happening forever, where you break out and you don't get much upside. The other theme that I'm seeing now, that is the most recent theme, is a lot of stocks emerging up the right side without developing the right side. Now, this can frustrate people that are starting to learn what I do, or even an O'Neill, where you're looking for the handle phases and all that. And then they start running up this right side. And you're like, hey, well, this doesn't work anymore. Maybe everybody's anticipating it and it doesn't work. No, it works perfectly fine. It's just not working right now. and certainly in the early stages of a bull market, or the late stages of a bear market, if we are transitioning, this could go on for a little while until you start to get the setups that start meeting the criteria and acting more orderly. And that's just related to the volatility. That's why I showed you guys in the weekend the volatility, that although the volatility comes down and it gets down to that 20 level, the real big uptrends happen below that. So we're not at those lower volatility levels, and that's where you get the more orderly setups, and you get the breakouts that don't have all that volatility that whips you around. And you simply have to, if you want to trade low risk, high reward, and high probability, you have to wait for that environment. That environment, if that environment was on the table all the time, I'd be a trillionaire. So it's not on the table all the time. Sometimes it takes a year or two before you get a really great, certainly when you have a bear market, it can take 2000, went all the way to 2003 before I started getting, in the market and getting good opportunities. But the big bull markets, the bigger the bear market, the bigger the bull market you have. The longer you go where it doesn't work, the greater the opportunities you have on the other side. So instead of getting discouraged, just realize that every day you're getting closer and closer and closer to a great environment. And that's what's kept me going for 40 years. And it's made me, many millions of dollars, is by staying focused on that. So I know I got off your stock a little bit, but so now you're in a situation where you've run up here and you've got what looks like a nice little power play base, but you don't have the gain for the power play. So you don't have that type of, so you could play this, but it just doesn't have the liftoff to confirm that this smaller base is maybe, okay, if you will, as it would be with a power play. This would be fine. This would be perfect. With this, you're looking at, this is just a natural reaction, and you're trading a little bit extended. But again, it's somewhat semantic. I mean, it's if it comes out here, it's certainly tradable.
Okay. I'm also going to just make the quick comment, because I do see a lot of ticker symbols being typed in today, that the symbol Dropbox is how you can make sure you get your symbols in front of Mark. So I'm trying to ask the ones that are a little more of a chance to learn of what is setting up properly versus not. But I do see a lot of symbols. So as a quick reminder to use that feature on the platform.
I mean, 99% of the time, guys, if it's not on focus list, then I'm probably not going to say, oh, that looks great, because we screen the whole market. Now there's times where you do bring stocks up and I go, oh, that's interesting. I didn't see that, but it's like 1 out of 100. So, I'm not perfect, but I can tell you right now, just throwing random symbols at me almost every single time, I'm going to say, well, I wouldn't buy it. Otherwise it'd be on focus list, because focus lists aren't even my buys. Those are just stocks that are close. So it hasn't even met that. Now, sometimes they're very close though. And they can be a stock that has not gotten to that point, but is on my watch list and could be at that point tomorrow, with just a day or two.
Yeah. And that's a good point. I think that is valuable for learning. If it's not already on Mark's focus list, try to really discern yourself. What is it that is not, why it's not, what is it missing, what characteristics, what features? That's really the learning lesson to be had. And studying,
but
studying
again,
the focus list.
Yeah, but I'd rather have you, I mean, that's certainly one way of looking at it, but there's a million things that could be wrong. So I would rather have you look at the focus list and say, what does this stock look like that this stock doesn't look like, and do it kind of in same thing that Bob's saying, but just do it in reverse, where start with a great looking model or something that's close, and then try to back into that with your selections. That's how I started. I started looking at the O'Neill studies and read O'Neill's book, and went back, Giller, love and just study the winners and the buy points of what a setup looked like before it made a big move, where I could buy it, not just a stock that made a big move, but being able to get on board at a low risk entry point. Because it doesn't matter. You can go back and say, well, these are the characteristics that, they had earnings, they had this, they had that. But if you had to go through a 25% pullback, and you say, well, what did it matter? Amazon went up 80,000%. So I went through a 25% pullback, because that's in hindsight. That's in hindsight. Well, every 50% decline starts as a 5% pullback. Every 25% decline starts as a 5% pullback. Every 50% decline starts as a 25% correction. So yeah, in hindsight, but you have to manage risk in real time. So that's the key. The key is to study the winners, but then you've got to find those points at which you get on board, that you're getting on board on a very low risk entry point. So now that upside pays for the risk. If you have too much risk, then all that upside, it doesn't pay for the risk, because very few stocks are going to turn out to be Amazon or Netflix. Right? You're going to have a lot of stocks that don't do that. And now it's going to all come around an average. Even traders that, I've analyzed portfolios and traders for, 3 decades now. And even the guys who worked for me, or guys that I trained, that they made their money from having, an occasional giant winner. When you go back and look at their average gain, it was like 15%, maybe 20. I don't think I've ever seen an average gain much more than that. You can even have an average gain of 12 or 15% and still have where your big winners are making a big impact. But still, that bell curve, you've got to manage that. That risk still has to be commensurate with that average gain, not your occasional winner. Keep that in mind. I don't know if that makes sense, but.
Yeah, thanks, Mark, because that's where I was going to head after that comment, is studying the best setups and the best winners is obviously the best way to train your eye. Curious question here from Renee. She's considering competing in the USIC, US Investing Championship, for 2023. She's wondering your thoughts if the field would be smaller and softer coming off of a bear market, or would it be the opposite, that the higher quality players would be at the table that survived the bear, ready to pounce on the new bull? So she had that question.
I have no idea, but I don't think you should if you're making the decision that way, it looks like you're trying to win and beat weaker players. I mean, that's not what it's about. Look, and I don't know if you're relating it to when I talked about, trading in the market in a good environment is like having weaker players at the table, but not when I'm in a contest. I want to be going against the best. I mean, that's like, even with my shooting competition, I worked my way up to where I was going to competitions and shooting against the best in the world. I mean, otherwise, what does it mean if I beat someone who I'm better than, and I go into a low level competition? The U.S. Investing Championship, no matter when you go into it, it's going to have some very competent people in there. When you've got 200 or 300 traders there, I assure you there's going to be some Sean Ryans and some some Mark Ritchie calibers in there. So I don't think it really matters. Don't wait and try to time it. Just get in there and put your put your feet in there and compete. I guarantee you, competing in the U.S. Investing Championship will improve your trading, because now you're going to really, it's going to really hone you down to to really being selective and trying really hard to get that performance.
All right. She also was asking, just to get a question about tennis ball action. She, on Texas Roadhouse, was trying to see if the 29th November, 29th and 30th would be examples of tennis ball action.
29th of November?
Right.
29th of November is down. I'm not sure how that would be tennis ball action. First of all, I mean, again, this is explained, in my books as far as natural reactions. The tennis ball action, what we want to see. Tennis ball action, what we would want to see is it go into new high ground. When I refer to tennis ball action, I refer to a pullback, a natural pullback, that after you break out, then you pull back. And then from there, you get back into new high ground. And the way that you want, this was starting to look like tennis ball action right here on 11/10. So you see how many days here, you peak here on 11/2. Now, 1, 2, 3, 4, 5, you spend 6 days pulling back, right? But then you erase it all in just 1 day. Now, if we could follow through and we didn't get clobbered the next day, that would be, I would define this as a natural reaction, because now I got that tennis ball action. I'm into high ground. So now looking back here and with this next day taking into consideration the rest of this action, this is the natural reaction, and it's a little long. It's taken a bit of time here. So this is actually turning into sort of a base on a base now. But once again, you see, you didn't really get a good right side development. You see, it ran up here and never really put that right side where it should have. And now, so you're paying the price. It's going to take a little bit longer. And that could be the whole market, just, the market runs up real quick here and a bunch of stocks run up. You're going to, the type of action that you get in the bases and so forth, whether they come off a low cheats, handles, or if they're long bases, short bases, deep bases, all that is going to be a function of the overall general market. So if you get a real deep bear market, you're going to get deeper bases. You get a long bear market, you're going to get longer bases. You get a V-shaped recovery, you're going to get a lot of stocks that run up the right side and don't build the right side, don't have that right side development. But to answer your question is no, that's not a tennis ball action.
Question on Wing, WING.
Another
Which is-
early turn.
Yeah.
Barely
kind of
turning here.
I know. That's the question is, though, more on, is the previous price action too much beneath the 200-day moving average for you to consider this? But I would be also questioning the amount of the sell-off in the base.
You don't
extensive.
concern yourself with the previous action. You concern yourself with the action that it's above the 200-day and meets the trend template criteria, the stage 2 trend template, or at the very least, the early turn. So that's what you want to concern yourself with. I don't concern myself with how long it traded below the 200-day. So no, the answer is no as far as that is concerned. But this here is clearly not in an uptrend, not for very long at least. So you're not in a stage 2 uptrend.
And the depth of the base as well.
Doesn't mean it can't work, but it just means that your the probabilities. Well, yeah. I mean, you got a pretty deep decline here. 63%. So again, and this isn't a power play, so it's definitely a concern. There's a lot of supply. Again, if you just use the trend criteria, the trend template criteria, you won't even look at these names. You'll be looking at the names that meet the criteria. But if you're so afraid to miss something and you're going to break rules, to try to make sure that you get everything, then you're going to have nothing. You have no strategy. You have no system.
Pinkaj is asking, he missed the entry of KRTX on Friday. Is it still something that could be entered today? Particularly below KRTX, particularly at a lower price point than the entry was Friday.
I mean, certainly it could. I still think this is, we didn't get much of a breakout here, so I probably would, wait. I don't think I'd buy it right here because I'd wait and see if it can tighten up and then break out from here. I think you might get a better breakout. But yeah, you know what you're saying. You missed it, so now you buy it now. You're getting a discount, right? You're getting lower than you would have paid. So that is the exact opposite of what I want. I mean, Mark, once you get a breakout here, I mean, if you bought it, would you be adding to it now that it's not following through?
Yeah, absolutely not. And you really want to almost reverse your thinking. If your thinking is, how do I get a breakout cheaper? I mean, if you think of it in terms of, take this as an example. If you buy this way, you're guaranteed to be in all the worst situations and miss all the best ones. Yeah. Because all the worst breakouts are going to pop their head out, pull back into the range, and then eventually stop you out. And the best ones are going to break out and never look back.
Yeah, usually.
Of the absolute best ones, you get put under no pressure. So I'm saying you're guaranteeing there, to be in. I want to have as many trades in the exact opposite of the way, sort of this individual's thinking about it.
Yeah. Another thing, the way I look at this, whenever I'm adding to a position, I ask myself, would I be buying it here if I didn't already own it? And just the opposite too. When I'm buying a position, I say to myself, would I add to it here if I did already own it? And sort of that sort of narrows it down to, okay, is this set up, from this point where I'm making a good risk reward decision? Now, if this had broken out, let's just say this came out for a couple of days and we got that follow through that Mark's talking about, this comes out and it moves up maybe a couple of days, like I pointed out with NUVL, which I'll go back to in a second. And then maybe it pulls back to the breakout here. That's acting a bit better, and now, on the heels of a couple days up, a week, maybe a weekday in the market, as it starts turning up from there, that'd be a better, time to be thinking that way, if you will. Something like NUVL, where you got a couple days here, you got the reverse recovery, a couple days, and now it's just pulling right into the top, of that breakout. This would be one that I'd be more inclined to apply that type of thinking to.
Carmen is a new member to MPA. She's asking if there is any type of beginner definition of some terms that you're using, like short and extended and things of that nature. Where would one go to learn these terms that you use?
I'm not sure, where you would go to learn those terms. I know O'Neill talks about them a lot, and I talk about them a little bit in my books, but it's from a very, starting level. Extended just means a distance away from the breakout point, your base, for instance. Stock like this, if you're looking at this as a base here, well, now that it's up big here, you're extended. You're a good distance away, or even from a moving average. You can see how far you are here from, this is the 20-day, so you're a good distance from the 20-day. That's what we mean by extended. Or the stock is up, maybe, this base is your third or fourth base, and it's run up and it's extended from those other bases. So those are the the general ways we look at being extended. But just if you're new, just hang in there, and you'll hear this over and over, and it'll start to make sense after a while.
Okay. Pete is asking, when making a buy, is there a rule on the spread between the asking price and the pivot point? How much you want to buy the stock, or how much the spread is considered to be too much?
Mark, we talked about this the other day. Maybe you could address that. He's talking about the spread between the ask price and the pivot point.
That's what he wrote.
Yeah. So if he means by, a rule, I don't have a rule in terms of, when we were talking about this, I think last week, I was saying, if it's a spreadier name, I want to see that bid coming up. So let's say, take for example, the stock you have up. Say you want to buy the stock at 35, but it's spready. The bid's at 34. A dollar spread on a $30 stock. That's pretty spready. I would want to see, let's say the offer's at 35, and that's the pivot point. I would want to see the bid coming up before, or even some trading at the offer, that they're starting to take what's there on the offer before I would buy it. I don't know if that's exactly what he was getting to. That would be the one thing in terms of a spreadier name. But if the offer's above the pivot, I'll buy it. I will consider that stock, having broken out in terms of, let's say my pivot, the offer is 2 cents above and it hasn't traded, where the pivot point is in terms of my alarm. Then I might just go ahead and buy the name there.
Yeah. So no, everything Mark's telling you is absolutely, accurate and correct. But it is the myopic part of the equation, if you will. That's looking at it as sort of in a vacuum of answering your question. But here's the way I look at it: spready stocks, is all about the size that I'm putting on. So if I'm putting on a lot of size, then I know, that spread is $1. Well, if I buy 10,000 shares, I'm at a 10,000. I have to say, no, I'm at a $10,000 loss right away. And that's the first question or first thing that I have to answer. Am I okay with that? But I tend to shy away from the spready stocks when the market's not doing well, and I'm not doing well with my trading. Now, when things are really working, I almost completely ignore the spread, because then stocks are breaking out. They're working. You're getting bailed out of spready, spreads. You're getting bailed out of a lot of your mistakes because everything's working. So that's sort of the bigger picture, that the way I look at it. I don't really go in there and say, well, if it's this amount of spread, I'm going to trade it or not. I'm trying to trade the chart. I mean, that's the key, is I'm trading the chart, and the spread. I want to get into a market that that it's good enough where I can not have to worry about the spread. Let's just put it that way. We're not in that market right now, for sure. But there are times where, and I'm sure Mark, when things are running and he's just running the table, if you will, like in pool, running racks, he's a lot less cognizant of the spread. At that point, things are working, you're buying the stocks, so that, I think that's a bigger picture to look at as far as the spread. The smaller, the really myopic thing to look at is how much loss are you going to be at, versus how many shares you're buying. And that's got to be taken into consideration, because now with that loss and where your stop is, if the stock just turns around on you and now goes down another point, now you're at a 2-point loss. Now you're at $20,000 loss on that 10,000 shares. That could get you right to your stop very quickly. So you just have to be cognizant of that versus your risk.
Okay. Question from Constantine is asking how to go from cash to margin. What are the best practices and what should we not do?
Okay. Well, once again, I'll let Mark answer this. I know what he's going to tell you, but I'd like to hear from him.
Well, yeah. First is follow the stocks, how to go from cash to margin. So if you're in cash, presumably things are not going well and there are very little setups, and what setups there aren't working. So the first thing you do is start small and build on success in your own trading. So meaning if you buy 2 names and they don't go anywhere, you see more setups, I'm probably not buying more until, something that I'm buying is working or showing me signs of progress. So in terms of what not to do, the biggest way to keep yourself out of trouble is not adding until things are working. So I've been very defensive all year because things just haven't been working. I'm going to stay there until that changes. So that's probably the biggest thing. And then in terms of margin, it's really just an issue of, as long as you have profits, things are working and there's more merchandise to buy, you continue to buy. It's as simple as, if there are, the best opportunities are when there are more merchandise than you have money to buy. That's the best sign that you should at least be entertaining the idea of margin. When you're fully invested and you still have a lot more ideas, that's how you do it.
Yeah, I just want to say that again, this is a question that I'm looking at and I'm reading as potentially dangerous, because you're saying, how do I go from cash to margin? That's like such a big jump, so I want you to be really careful from going from cash right to margin, or even thinking in terms of moving quickly, of having the mindset, well, I want to get to a real aggressive position very quickly. And the key is, the question really should be, how do I go from cash to 25%? And how do I go from 25 to 50 and 50 to fully invest it, and fully invest it to margin? So that's just such a huge jump that it makes me a little nervous to hear that question. I'm never going to go from cash to margin without going to 25, 50, 75, 100, and sort of, ratcheting my way into that position. And I'm never going into margin until I'm doing really well. I reserve margin for the absolute best of times, when everything is working fantastic, and on very, very low risk entries. So that's just my comment on it.
All right. Eric is asking, what's a good way to track my equity curve, something with a graph, and how would doing this tracking help me with my trading?
Your equity curve, a lot of brokerage firms allow you to do that. I'm not sure where you're trading at, but maybe you should, if you don't have that available in your brokerage firm, maybe look at some other platforms that allow you to do that. But you certainly, you might want to also, track it weekly, or definitely monthly. You want to look at it monthly. And if you just put it in a spreadsheet, in an Excel spreadsheet, put your monthly numbers, and then you can chart it. That would be the easiest way.
Andy was going back to AEHR, trying to understand with the stock that was a 75% correction.
Which one?
AEHR.
Yep.
Over the last year.
Yeah.
Going through that 75% correction, would that make would the fact that it made a mini base between August and November negate the prior 75% correction? Is that,
A mini base would erase the correction?
not a mini base, even though he's using that term, but the base from August to November, would that negate your previous 75% correction, that you would not eliminate this as a result of that
Well,
deep
I
correction?
don't know what negate means. It doesn't mean it never happened, but I guess, I obviously, I realize you don't mean that, but, no, I mean, the fact is that if you have a big correction like this, a couple things that you're going to want to, have on the table in order to trade something that has so much supply to the left side. One is you're going to want as much time away from that area as possible. And when I say time, you're looking at a year, maybe a year or two. The other thing is you want a lot of iterations of tightening on the right side. You want base building on the right side. Or you want it to be very explosive off the bottom, something like the MGNI, where you've got a nice explosive move, and maybe you have a power play situation. I don't know if this did that here. Pretty much. This is almost right here. You can see off these lows. And again, I wouldn't be trading this below the 200-day moving average probably, and with such a big decline, but you can see how it's even playing out here, where you get a real explosion, almost a double here, and you get that pullback, you get your first little cheat area right here, and there's a nice little buy point, right? And you get a trade out of it. So a power play situation. Otherwise, you want the bigger the base, I'm sorry, the deeper the decline, the bigger the base you want, and the more time. And you got to just be cognizant of what's to your left. Always look to the left, like you're looking for traffic. And then you start to see, okay, where's the supply? How much supply? How's the stock acting going into that supply, and so forth. So I'm not really sure, this negating question. I don't really know what that means, to be honest with you.
All right. Tom Payne's asking for a shout out to his Bengals beating Kansas City. MACK, Rick is asking if that's still being entertained.
Well, the way that this is acting, where this super tight all this time, this is starting to look to me like a takeover stock, where you get a proposed merger or something. And this to me is a little abnormal. I don't know, Mark, what are you making of this? We haven't talked about this, but here it was tightening up, but now this is, it's tight. Everybody looks at this, they're like, wow, you want tightness? Yeah, that's pretty tight, and it's drifting back a bit here, and this may work, but this is so tight that it's looking almost like when you get a proposed merger announcement.
Yeah, or like the train's not kind of coming in on schedule. I would expect this to either have set up. It's sort of just, there's not a clear pivot anymore. It's sort of, I guess you could play it. You really aggressive would be maybe through Friday's high.
Yeah.
But yeah, I would agree. It doesn't mean it shouldn't be potentially entertained. But yeah, normally it's sort of, this is why when they're too long, when the pivots get too long, they become abnormal. And that's what I'd say. This is sort of in that, getting into that category.
So what you're looking for, let's just say, you can't define a real, this is all a pivot because it's so tight. But when you can't define, where that exact day that you want to, trade it above, what you're trying to find or look for is, where does the majority of the price action reside? Okay. And where do you clear the majority of that price action? Now, if you're on a low cheat, that you're going to have a lot of price action to the left. But here, you draw a line across here from that previous high on Friday, or even maybe up here, you see that almost all the price action is contained around, just below around that 1250-ish level. So that's where you want it to clear. You want it to clear that price action that it's been being contained all that time. So that's how I would trade this. But I've been really, struggling with this one, and watching it and trying to figure out what's going on here, because the only time I usually see it this tight, in my entire career, I've seen these maybe 2 or 3 times that weren't proposed mergers and actually worked. So not sure what's going on here.
Okay.
This is one I want to learn a little bit more about what's going on fundamentally.
Not sure. Paolo's asking on MGNI
Yep.
if NKRTX actually, if they're behaving constructively, is today's behavior an indication of lower relative strength?
Well, I don't know. I mean, as far as I can't tell you exactly. I mean, if you look at the market and you look at then the S&P is down 1.27%, and you look at the stock, the underlying stock, like an MGNI down 5.92. Yes, today, if you were to compare it today, it is the relative strength is underperforming the S&P 500. But I'm not sure I would really gauge anything based on that short, that short of an amount of information.
And would you consider them to be behaving constructively?
Yeah, so far, I mean, MGNI is more constructive than KRTX. We talked about KRTX, where that didn't really just take off. So this is still holding up in the base, but hasn't broken out yet. So this is constructive in terms of building a base where you can still buy this if it breaks out. MGNI is completely different. It's gotten extended and run up this right side, so I would not buy this. But this is acting constructive considering it ran up 20% in 3 days. Yeah.
Sherry's asking, since she's trying to streamline her screening and knows that only a handful of sectors or groups have generated super performer, the majority of the super performer stocks, and she's asking if there are any particular groups or sectors you would suggest excluding from your screening parameters.
Well, the first thing I exclude is the ETFs and the exchange traded funds and things like that. And then on some of my screens, I exclude banks, SNLs. I would say probably good to run maybe an everything else screen, like where you put. This is one way to do it. I'll just give you one suggestion. One way is to run a screen that you look at everything except the areas that are the deep cyclicals, like the papers and the steels, and the groups that would be sort of the the worst groups, the most cyclical groups, the gold stocks, mining stocks, things like that. I don't know what else would make that list, Mark.
Yeah, all tobacco, consumer discretionary,
defensive
that kind of
names,
stuff,
all
defensive stuff.
and sort of run that, what you could even call it, the everything else. I call it the everything else screen. And then, so now you've got sort of the optimal areas that, you want to focus on. And then you run the everything else screen. And a lot of times when you do that, and I sort of do it just automatically when I run through my screens, I sort of see that. I see how many stocks are setting up in those areas versus the other areas, and I kind of get to the same conclusion. But you'll start to see, where there's this shift, and wow, all the cyclicals and the defensive names are setting up and working, and this area is not working. And that really give you a good idea of the health of the market or the type of market you're in. This is sort of what has kept me on, the right side of the market all through this last year or two, is that differentiating from that cyclical side. And even now, you take a look, the Dow 30, it's very narrow. You're seeing a lot of names, coming from that list and not from the growth side. So that's one way to do it, split it up like that. But I would exclude the ETFs. That's the main thing. And again, if you start excluding things, you got to realize that you're going to miss names, that might be set up and might be buyable. So you want to try to have the screens as wide as possible. But if you want to start narrowing it down and sort of having, this is my my A list, then that's the way I would do it. Do the A list and then have the everything else screen, and that's your B list, your B screen.
Right. Also, as a follow-up, Sharon's asking if you know if the VCP setup works well with the E-mini futures.
Oh yeah, absolutely. But the thing is that here's the benefit of the stock market. Number one, you've got the chance of having an inefficiently priced security is much better than if you were to trade futures, because futures is only so many, right? I don't know exactly how many, Mark would probably know that, but there's only a handful of futures, right? And so you have all these eyes on just this small list. So that the chances that you have something missed or there's inefficient pricing is much less. All right. So now that's the big reason why I stuck with stocks from day one, is I realized, and especially in the early days, these small and mid cap names would literally just go completely unrecognized by analysts. And even today, they still do. Probably more so now, or just as much now as ever, because small and mid cap's been so out of favor for so long. But even stocks that trade at low volume, they would start breaking out, and the market makers would not even see it until. And they have to short the stock, and there'd be this short covering rally from the market makers because they didn't have the computers. Now the computers are tagged, so you stocks, you can't run a market maker in or run the shorts in as easily. So I know I'm going way into the deep forest here with this stuff, but the bottom line is that because you have so many stocks, analysts can't cover everything, and they don't want to cover everything. The analysts are going to cover the bigger companies, and the smaller companies and the mid-cap companies, and in some cases, even companies that are big or just haven't gotten the analyst coverage yet. That creates inefficient pricing, where now you have the opportunity. See, if everything was priced perfectly, if all information, the random walk hypothesis says that all information is in the market. Like, you buy any information that you have, you can't beat the market because it's already priced in the market, and the market is a perfect system where it discounts. Well, there's a lot of truth to that when you start getting into futures and the S&P 500 and bonds. Yes, it's very, very random and very efficient, but it's not completely efficient. Even that can be beat. But when you start going into individual stocks, now it's not efficient at all. It's very inefficient. So my answer is yes, they can work, but it's going to be you want more jockeying for position, less opportunities, more shakeouts, just a lot more asterisks and caveats and jockeying for position. I don't know how, in your experience, Mark, hearing what I just said, how does that play into your own personal experience? Because I know you've traded, you do trade futures from on occasion.
Yeah, and everything you said is 100% correct. The entire tangent on efficient versus inefficient pricing, and I know there are vast levels of experience, listening to this, but it is never truer than today. In the difference that between the markets are efficient, but they're not perfectly efficient, is what Mark is saying, and the difference between those has been worth millions to Mark, myself, and lots of other traders. Yes. And that's what we're looking for, is to exploit that difference. And so there's more edge if you think of it in that regard, in situations where this is why when you hear someone like Mark saying, well, there's a lot of eyes on this one, what he's saying is it's potentially more efficiently priced. That's really what that means. But there's no question, in the same where we talk about the prior question about should you exclude some of these other groups? Listen, if I could only trade bank stocks, I'd still be trading them from VCPs, guys.
That's right.
If I could only trade insurance or some of these less sexy groups, I'd still be using the same criteria. I'm just saying it's because those are more efficiently priced. That's why I don't favor them as much. But and the same goes for whatever market.
And there are times, in all fairness, Mark, there are times when those areas go into favor and they do well,
Absolutely.
and again, by running those separate screens, you can illuminate that and see that if you don't have the eye to be able to run one big screen and sort of differentiate that as you're just looking at the stocks. Another way is to just sort of segregate it into groups and then run those various screens, and you'll see the areas. That's one of the ways I like to. One of the ways I like to screen where I'm able to run several screens, but I don't chop out the market and miss. I want to see everything. I want to see everything that meets the criteria, even if it's from a group that isn't the historically the best group, because I don't know, maybe oil stocks were going into a new bull market in energy here. I still want to see that, right? So one of the ways is to run it in tranches. I do this with market cap, or I do it with shares outstanding. I'll run a 25 million and below, a 25 to 50 million, a 50 to 150, and 150 and above shares outstanding. And I run, if I run those 4 screens and just look for RS, minimum RS cutoff, I see virtually everything. And I also get to see right away if the small mids, the smaller names or the big caps, which area is working as far as capitalization or liquidity wise. And that, that for many years, it was the big 150 and above was where all the action was. And then you go back into the 90s, there was a period where, it was all those really smaller names, small and mid caps where all the action was. And the big caps were all stalwarts, back prior to the FANG stocks, there were still glamour stocks that there's always, popular stocks that we call the glamour stocks. Stan Weinstein has the glamour index. But again, the bigger names were usually the stalwarts. They were the ones that, they were already not, the efficiency is now out of the stock, or the stock is now efficient because they're followed by, Coca-Cola is followed by like 60 analysts. Then you get this little company like, I don't know, MGNI, for instance, here. This might be followed, I don't know how many, but we could look and see it might be followed by 1, 2, 3, or 4 analysts or 5 analysts. So again, a lot there that's not on the table as far as the coverage. The other thing too is I wanted to make this point before. It's another reason why we want to be involved with momentum. See, when you get a move like this real fast move, something is happening here, right? And if it's really significant, even though you've got this big price move, there's no way that this is discounting at all. If it really is a significant change, and this is your first indication that something is happening here that's big. Or potentially big, or being perceived as big. I mean, that's really the important thing, is the perception. It doesn't really matter what the reality is. It matters what the perception of the reality is in the stock market, because that's what we're trading on here. We're trading on perception. This is like buying paintings, like you're going to an auction. It's like going to an auction and buying paintings. It's only worth what somebody else is willing to pay. And that's all there is to it. The canvas and the paints are worth $30. But Van Gogh will sell for 100 million. Why? Because there's a willing purchaser. It's the same thing here. Until you start looking at stocks as perception, you are a potential disaster just waiting to happen, because you're not getting intrinsic value here. You're not getting a piece of the company, as some people think. You're paying a gigantic premium. All right. And most of it is all perception. So that's why, minimizing your losses is so important. I know today, I will call today's session the digression session, because I know I'm going into a lot of areas, beyond the questions, but I guess I'm just getting hit with a bunch of ideas here to give you.
That's quite all right. All helps. Carlos is asking your thoughts on UFPT, which came up on his code 33 screen. He bought it on the November 17th and is looking to add to it.
November 17th. Yeah. I mean, I wouldn't have bought it on November 17th. It's extended, and I wouldn't be buying it here, but I see what you're doing. This is extended, maybe over here, coming out of this base. Again, my buys are all very disciplined as far as they're coming out of bases, or they're pulled back to the base, or they're somewhere, within the base or close to the base. Once we get very extended and you get a small little reaction like this, it's going to need to be a power play. I didn't even check here, but no, this is nowhere close to a power play. It doesn't mean it can't go up and double from here or go up tenfold from here. It could, but it's just, the risk for me is too much here. So I would not buy it here.
Yeah. John is asking about ENPH.
I do have a hard stop at 12:45.
Okay. So a few more questions here. John is asking about the ENPH move on Friday. Would you add to it now, or wait for a pullback buy opportunity to set up?
Well, I don't see a real reason to add. I mean, if you're watching it all along, you should already have your position on. Now, this is a stock that you're coming from this base, you shouldn't be pyramiding into. We already had those opportunities right here, a little short right here. Again, when I bought this was on was the last day, 11/18, right? Yeah, 11/18, which is right here. All right, sorry, right here. So that was that day where it came out, and it was a little bit short here. And if you remember, my comments were, this is where you can maybe buy a little bit and then add to it if it tightens up, or you'll have a small position, and if it works, it might spend a little bit more time. But now it's gotten really quite perfect. And so, I mean, yeah, you can add a little bit to it, but you're trading it extended. Here's the weekly. The weekly looks pretty good here. I mean, this is really looking nice now. So I would not add to it here myself. I'm already into the full position. So right through this pivot here is where you want to. Now again, where is it in relation? Yeah, so you're up about 4-5% from the breakout. So to me, that's too extended to add to it.
Okay.
And the other question, like I said before, the question I asked is, if I didn't own the position, would I buy it here? See, here's a perfect chance to use that thinking. If I didn't own the position, would I buy it here? Well, then why would I add? If the answer is no, then why would I add?
And Jeff was asking actually the same question about ENPH. Fred mentioned he bought ENPH on November 23rd and then added to it on the 30th, which I think was just last week. Would you consider the second buy a proper pullback buy where he bought it on November 30th?
I don't like the second buy at all, because it's not, see, you're adding to a stock that you're down on. And so I would have waited until it got into new high ground or tightened up like it did. If I had bought it where you bought it, I don't think there's anything wrong with the first buy, but the add, I would rather have that add be my first buy. If I didn't buy the first buy that you made, then that add would have been my first sort of toe in the water on the pullback buy, maybe 25% or 50%. And then as it broke out here on Friday, double up on it or triple up on it and move it to full position. But you did it in reverse. You bought the breakout and now the stock's not working and you're buying it as it's turning up. I see what you're doing, but that sort of looks like that's more averaging down, as opposed to pyramiding in. So, and if you're trying to build a position, let's say you did it this way. The only way I would do it, say your way, is if I bought 25% on that first one, got a pretty small position. And then on that second one, I'm only buying another 25%. So I'm still keeping it a small position and I'm building my position. Maybe you were anticipating that it was just going to take off and break out. That might be okay, but I wouldn't get more aggressive on that second buy. I get less aggressive or equally aggressive as long as I'm below, the fully invested mark on it, if that makes sense.
Yeah. All right. And I think there was one last question I wanted you to hit real quick. If you can, Mark, Michael's asking, the charts for oil and natural gas both look broken, but yet the stocks in the groups are still looking to be amongst the strongest in the market. How can this be? Shouldn't there be a strong correlation between the price of oil and oil stocks?
Well, if that's the case, that would make the equation pretty easy. You wouldn't look at the stocks, you just look at oil. So, I mean, you could say the same thing with gold stocks. You can say the same thing with a lot of things, but if it's no, it's not that simple. So I can't tell you what in any one day what the relationship is going to be or should be. It is what it is, and your job is to interpret it. But again, I'm not going to worry about that. I'm just going to watch the stocks, and when they set up bases and they meet the criteria, put some positions on, and if they work, add to them and use the same criteria. So I hear what you're saying though. Oil is come off, but we don't know if the stocks are discounting or, we just don't know how far forward which instrument is looking. Oil might be right. The stocks might be right.
Yeah, I was going to add just real quick. Oil may have gone up, and the stocks were already discounting that in advance and having a further rise than the actual underlying commodity did. And now it's and vice versa. And now one's correcting, but the other one didn't go as far as meaningful. You don't
know if underlying oil, or let's just say anything, copper, with companies that make copper wire or whatever, let's just say any company, you don't know if the underlying economic conditions change that actually change the conditions that the company can now operate in going forward. And that was sort of the catalyst, or provided those conditions. And now conditions are better going forward for some reason, or perception has changed. You just don't know. You just don't know those interrelationships. So trying to figure that out, I assure you, if you want to get rich trading stocks, that's not the way to do it. That's the way to drive yourself nuts. And you know, I'm not smart enough to figure that stuff out. I can tell you that.
All right. So with that said, we'll wrap up here today's session. We'll have the replay available here momentarily on the live stream, and also stay tuned for live real-time alerts from Mark throughout the remainder of the week. And we'll thank Mark and Mark for your time this morning.
Yeah,
And
we'll do this again if you know things are slow, and we're not running a lot of stock positions moving. We'll do this again probably at the end of the week, maybe on Thursday.
all right. Sounds good, guys. Thank you again.
Okay, see you guys. Bye.